Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, February 5th, 2010. Before we get into any market highlights, let's take a look at today's main fundamental release, which was our non-farm payroll report for January for the US. The report showed that the economy shed an extra 20,000 jobs during the month, which was weaker than the flat reading expected by economists. And we also saw that the December number was revised to show a larger than expected amount of jobs lost. The original reading was at 85,000, but now that was turned to a negative 150,000. However, November's total was revised upward by a similar amount. What was originally a 4,000 job gain was instead revised higher to show 64,000 jobs gained. The main loss of jobs for January was in the construction sector, which saw 75,000 jobs lost, while we did see retailers adding 42,000 jobs and temp help services adding 52,000. Also encouraging was the manufacturing sector posting an 11,000 job gain, confirming some of the gains we saw in the ADP private sector survey as well as the ISM manufacturing index. The unemployment rate, meanwhile, fell actually to 9.7% from the 10% we had seen in December, which was better than expected reading. Now, a common question would be, how could there be fewer payroll jobs but the unemployment rate still declined? That is because the data comes from two separate surveys. The unemployment rate comes from the current population survey, which is a monthly survey of about 60,000 households. The jobs number, however, comes from the current employment statistics, which is a survey of approximately 400,000 businesses. So, for instance, the payroll survey does not include those people that are self-employed, and so it's the household survey that gets us the unemployment rate. So overall, it's a bit of a mixed report, as it shows that the economy is unable to create new jobs, but on a seasonally adjusted basis, but the unemployment rate did improve. Looking at the euro-dollar pair, we see that the euro fell against the dollar, especially in New York trading, as traders for the most part shrugged off the jobs report and focused more on the euro concerns about focused on the growing investor anxiety over the deteriorating finances of some European countries, as well as a sharp slide in oil prices. So that hurt demand for riskier assets. The euro dollar sliding below 1.36 is now at a new 8-month low. The greenback had been gaining prior to the non-farm payroll report, but had a small counter rally that you could see here, which is common for such a closely watched report, as investors and traders adjust their positions after such a release. However, the focus returned onto the debt concerns in the Eurozone, and we did have some weaker stocks in the US, which boosted risk aversion, and which helped the greenback and yen gain in New York afternoon trading. So the cost of insuring Greek and Portuguese debt against default remained at record wide levels on Friday, and it furthers the theme that ballooning budget deficits in the Eurozone can hurt the economic growth there and can keep the European Central Bank from lifting interest rates. So we'll see if this slide extends when we return to trading at the beginning of next week. The euro was sold off sharply yesterday, and that sell-off continued in Asian trading, in the Asian Friday session. And here we're looking at the Euro-Swiss franc pair, and we see that the Euro-Swiss franc pair fell as low as 1.4550, and we see a very sharp reversal as the Swiss National Bank seems to have intervened in the currency markets in order to prop up the value of the Swiss franc. However, even that intervention was cut down, and in New York trading we saw the pair continue to slide in favor of the Swiss franc. The pound-dollar pair followed the lead of the euro-dollar pair and slid in today's trading from high to low. It was about a 200 pip move, and we see that a good chunk of it came in New York trading. So we hit a low at 1.5560. Traders and investors are concerned about the UK fiscal situation as well. The country is running record deficits, and the Bank of England kept the door open to further quantitative easing in its interest rate decision yesterday. The dollar-yen pair, after its sharp slide in yesterday's global sell-off, managed to rebound somewhat in the Asian session and consolidated here around the European trading. But as U.S. stocks soured in New York afternoon trading and Dow Jones index fell more than 100 points, the yen gained to test a new low for the day around 88.80. Risk aversion is causing traders to look for the safety of the Japanese yen, and it set new weekly lows today against the pound and the euro. Currencies sensitive to global growth concerns and the overall global economic recovery were on the back foot again today. Here we're looking at the Australian dollar US dollar pair. And following our sharp slide yesterday, we did break below our yesterday low, testing the area underneath 0.86. So we did have commodities falling further today, especially oil, though gold was down as well. In a look at another fundamental release, this time from Canada, we saw the employment situation there post a better than expected release. In January, the economy created 43,000 jobs, which pushed the unemployment rate down to 8.3%. January marked the fourth employment gain in the last 6 months, and a bulk of the new gains in jobs was due to an increase in part-time employment. The US dollar-Canadian dollar pair responded by falling following the Canadian employment report, falling in favor of the loonie. So we had reached a new multi-month high here at 1.0780, but following the release, traders bought the Canadian dollar and bid it to the 1.0650 level. However, following the New York morning session, we did have an increase of risk aversion as US stocks were lower, and with oil prices falling as much as 4% on the day, the Canadian dollar was sold in the afternoon session. So we came close to retesting that high we had set. If we zoom this pair out, we see that we broke an important level of resistance around 1.07 this week, and now today's high goes back all the way to late October, early November. So we end this week with a ton of risk aversion and the greenback and yen benefiting in the later half of the week on concerns over European debt troubles. Now let's turn to next week and take a look at the key releases to expect. Around the world, we have on Monday some important housing starts data from Canada. Tuesday, Australia posts its home loans. Wednesday, we have the UK industrial production data as well as the Bank of England inflation report. Also Wednesday, we get the Canadian trade balance and Australian monthly employment change. Thursday, New Zealand posts out its retail sales, and Friday we get our first look at both Eurozone and German fourth quarter GDP data. In the US, Wednesday will bring the trade balance as well as the federal budget balance. And Thursday we get data on consumer spending in the form of retail sales, while Friday we get data on consumer confidence. So that'll do it for our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site, FXTimes.com. I want to thank you for watching and wish you a great weekend.